Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Whistleblowers are going to come out on the day that he is testifying, because that's when it makes more of a story, and that rhetoric is playing out and will continue to play out for Boeing. I mean, it's a long-running PR disaster, and you know the show has more additions to give us in the coming months, I suspect.
You do have a consumer slowdown that is ongoing. The labor market also seems to be slowing and coming into better balance. But I think you need some context. So this morning's report for retail control, stripping out the volatile items, was actually up 0.4%. It was a decent print. Retail control over the past 3 months is actually the highest since December. So the economy is slowing, the consumer is certainly slowing. But at the moment, I don't think it's a worrying trend. I think it's just getting back down to where we think is a more normal type of pace for the economy.
We are looking for 60s next year. So we haven't seen that for a while. This summer still in the low 80s, but we think we're moving into the 70s for Brent for the second half of the year, and 60s next year. So significant downside versus now, significant downside versus the futures curve.
We've got 1 hour to go until the market close. So let's take a look at the major averages here. We've got the Dow little changed here today, up just about 16, 17 points. The S&P 500 is on the rise, about 0.2%. And the Nasdaq little changed right now. Remember, any gain for the S&P and the Nasdaq will be another record. Let's talk about some of the elements pushing stocks around today. We had this morning a retail sales report that came in below estimates, barely budging last month, a very, very slight increase. That's one thing that we've been watching. There was also an auction of 20-year Treasury notes, $13 billion worth, that saw relatively strong demand. So that demand coming into Treasuries is pushing yields lower. We've got yields down about 6 basis points today as prices rise. And then there continue to be fireworks here in large cap tech. I know we keep talking about, the rally's going to broaden at some point. Well, guess what? Large cap tech is still higher today, but really there's one large cap stock that we're watching in particular. That is Nvidia getting another high price target on the street. In fact, the highest from Hans Mosesmann over at Rosenblatt. $200 is the price target there. The rest of the mega caps aren't doing as well. Nvidia now, with that 3% gain, is now up 173% year to date. But not only that, it means that the market cap of the company is now the largest in the S&P 500 at $3.34 trillion. That means it's above that of Microsoft and above that of Apple. Now, it might not last, but this is the first time that we have seen it reach that milestone, Josh.
All right, Julie. So Nvidia, as you mentioned, its market cap surpassing not only Apple, but also Microsoft. The move bringing Nvidia to the top spot as the most valuable public company. Here with more on the fight for the market cap crown, let's get to Corey Johnson, the Futurum Group Chief Market Strategist. Corey, always good to have you on the show, my friend. Let's just go right there, Corey. I'm interested. You've been covering the markets for a long time. You've been covering tech for a long time. Over the course of your career, Corey, do you say, I would compare NVIDIA, or NVIDIA reminds me of, example A, B, or C, or no, we're in truly uncharted territory?
It's different this time? You want me to say it's different this time? You're begging me to say it's different this time?
It's good
It's
TV,
always
Corey.
different this
Come
time.
Yeah.
But there are always hints of the past. Look, the memories of the dot-com bubble, if you will, but companies like Dell, companies like Cisco, that had absolutely fantastic runs and relatively a lot better financials than some of the companies they were being compared to, had runs like this, and they went on for years and years and years. And they had times when the valuation was stretched, and they had times when the price was high, but the historic valuation was actually better than it had been. And thus is the way that industry leaders in new industries go.
Hey, Corey, it's Julie here. There's also sort of the speed, though, that we have seen NVIDIA move this time around, right? So we were looking at the number of days it took these various companies to get from $1 trillion to $2 trillion in market cap, and then from 2 to 3. And in NVIDIA's case, it only took 262 days from 1 to 2, and 96 days from 2 to 3, which is much, much shorter than the others. So what does that, I mean, what does that tell us about the sustainability, perhaps, of NVIDIA's growth here?
I think it tells us a lot about a lot, but I don't think it tells us anything about the sustainability of the growth. I think what it tells us about is the moment that we are in and the reaction to that moment. And both of these things are happening at paces that we haven't really seen at this scale in the past. We've never seen a company as big as NVIDIA was a year ago, which was very big, grow at the pace it has been growing and get to the size of revenues that it has achieved. We've never seen anything like this. And certainly to do so with fantastic profitability, expanding gross margins, ridiculous operating margins, and tons of free cash flow, and yet their customers don't seem to balk at this whatsoever. We also haven't seen the markets recognize such an amazing thing, but maybe it's understandable that the market is reacting to this quickly, noticing what's going on in this company because it is so big.
Corey, do you think it's a cause for worry for investors when everybody seems to be on the same side of the boat? Meaning, you look at NVIDIA, stock is a monster. Nearly 90% of analysts who cover it say, even here, buy it at these levels. You know, is that a reason to worry? Or, you know what, sometimes the herd is right.
Analysts always say buy it. That's what they say about everything. Buy it, buy it, buy it. They are always
they sometimes,
raising their price targets
Corey,
for the entire
sometimes they
market.
say hold. They do say hold. You get that.
Yeah, not much. How much do they say hold?
More than they say
5% of the
sell.
time?
I know that, yeah.
How much should they have said it in retrospect, right? So I think that that's not a reason to believe that this company is good. A reason to look at this company and understand what's going on so great is to look at the numbers and look at the growth rate and look at the free cash flow generation, which is the ultimate value or the ultimate success of a business. It's free cash flow creation. And NVIDIA is doing all of these things right now. But again, the pace of the growth of this size and what we hear from all of their customers, at Futurum Group, we talk to all of NVIDIA's competitors and all of their customers, and they're all trying to get more and more from NVIDIA, and they all want to buy that product first and everything else second. And none of them seem to be concerned about the price of what NVIDIA is charging. And recognizing that, NVIDIA is raising prices. NVIDIA is taking gross margin in ways you rarely see any business do it, let alone gross margin, operating margin as well. It's just fantastic.
And Corey, the company seems to indicate that it sees no sign of that slowing down. I mean, if you look at the estimates for earnings growth and revenue growth, they are expected to slow down a little bit. I mean, we're talking about from triple digit to double digit. And NVIDIA has pushed back a little bit on this notion that its chips will not be in as high a demand as this AI processing revolution kind of matures. But what do you think?
Well, so you asked a couple of questions there, and let's start with the first part last. But starting with what their growth is and what the market's going to look like, I think it's reasonable to expect right now that this market's just going to get a lot bigger. And selling AI for the purposes of chips that do AI for the purposes that we now think of AI as doing is a fool's errand. You know, when we first got our iPhones, we didn't imagine Uber, right? A multi-billion-dollar businesses being created, Instagram, things like that. It was just sort of faster email and a keyboard on the screen instead of on a BlackBerry, right? It was hard to imagine what the world was going to look like. Similarly, in AI, I think we're going to see incredible new use cases that are hard to imagine right now that 5 years from now will just seem like they're so obvious to us. So it's reasonable to expect unreasonable demand coming from places we can't imagine for AI and therefore for NVIDIA. But I think it's also really important that you brought up the point that the growth rates have been going up. The second derivative of growth has continued to accelerate and go up. That's probably going to change this year. We're probably going to see the growth rate come down for NVIDIA. It's still going to be amazing. It's still going to reflect tremendous growth on the biggest numbers we've ever seen from any company ever. But it's going to be a little bit slower, and I think that will be an inflection point for the stock market.
And Corey, you know, one hot theme that's being talked a lot about is how people look at this broad market rally and they'll say, you know, it's narrow. It's basically, it's NVIDIA and a few other big tech names outperforming everybody else. How are you thinking about that dynamic, Corey?
It is inevitable. We're going to see growth in we're already seeing growth in the numbers of lots of other industries, and we see it coming. I was doing some work today on Lam Research and Global Foundries, right? But related but different businesses going in different directions. But Lam Research had putting up a fantastic year. It's not NVIDIA, but it's on the growth of this AI stuff, if you will. Global Foundries, massively expanding their capacity to manufacture semiconductors, all with the belief that AI is going to spread the wealth beyond Nvidia. We're seeing that in the growth numbers. Look at ServiceNow. Look at Oracle, a stock that I own. You see growth from AI. It's not accruing only to Nvidia. The market is ascribing the growth mostly to Nvidia and a few others. But I think that we're certainly going to see the market start to recognize the other success that other companies will have, and that's going to continue to move, up the stack, if you will, when it comes to software and services over the coming years. We've only just begun.
Only just begun, as the song says. Corey, thank you so much. Appreciate it.
Good to see you guys.
And you, always. Well, a number of Fed officials providing commentary on their perspectives on the policy rate and the economy. Boston Fed President Susan Collins, for example, encouraging a patient approach when considering lowering rates. Richmond Fed's Barkin echoing the central bank's need for more economic data before thinking of adjusting monetary policy. Here to discuss is James Bullard, former St. Louis Fed president and dean of the School of Business at Purdue University. Jim, thank you so much for being here. We have been having this discussion a lot about where the Fed is, whether they are behind the curve or ahead of the curve here. So I'm curious first, what you think of that. Do you think that the Fed is late in beginning its cutting cycle?
Yeah, I think the Fed's been looking for confirmation of the decrease in inflation. Last year at this time, inflation was running, core PC inflation on a 12-month basis was closer to 5%. Now it's below 3%. So we've made a lot of progress in the last year, but they've been looking for an opportunity to make that rate cut, and they haven't got it during the so far in 2024 here. But I think they'll be able to get that opportunity. The most recent inflation report was very encouraging, and looks like if we can get confirmation on that in subsequent inflation reports, that the committee will be able to move ahead with a rate cut.
And Jim, switching gears a bit, you get retail sales this morning, weaker than expected for the second month in a row. Jim, I want to get your take on that report and just what you think it tells us about the American consumer here.
Yeah, I think the headline sounded like the core retail sales were actually pretty good. So I think some of this came from the more volatile elements and especially gas prices that were down a little bit. So I think that the consumer is still doing very well. A rule of thumb would be if the labor market is doing well, then consumption is going to do fairly well, and that's what's going on here. In addition, you've got the stock market and house prices at pretty high levels, and because of that, the higher end of the income distribution also doing very well. So it looks like consumption should be in good shape going forward, even though the headline number for retail sales was a little bit soft today.
Jim, how long do you think it will take for inflation to get back to 2%?
Yeah, so the committee doesn't say too much about this except in the dot plot, and usually they've got some sort of slow reversion to the 2% target. You might make some of the progress 1 year and then the rest of the progress the next year. And so that plot that you've got up now certainly shows something like that. And so that's usually the way this is conceived. And I actually think that's not too bad of a plan because you don't want to overshoot the target. You would like to asymptote toward the 2% target, have a nice smooth process that goes back down to 2%. So I think if I was still in the committee, that's certainly what I'd be shooting for. I don't think you want to get back into the below target inflation that we had in the 2010 to 2019 period.
And Jim, your take on sort of the overall U.S. economy, interested, where you think we are and where we're headed, whether, Jim, you're in that soft landing camp.
Yeah, I'm absolutely in the soft landing camp. I was an advocate of aggressive action in 2022, which we got with the 4 75 basis point increases in the policy rate all in a row. plus the Jackson Hole speech. I think that did a lot to set the tone that the Fed was going to take aggressive action to get the inflation back to target. And then in 2023, inflation fell precipitously. We're not all the way back to 2%. We still made a lot of progress during that time period. So it does seem like the policy worked very well. And so now it's just a matter of finishing the job. We didn't get much of a change in the unemployment rate during that period. We've still got a 4% unemployment rate, very low for the US economy. And we've had low unemployment pretty much the whole time we've been pursuing this policy. So looks like a soft landing to me. It's not quite over yet, but it's pretty much over.
Jim, now that you're sort of back in academia, I'm very curious, and now as the dean of the Mitch Daniels School of Business there at Purdue, obviously you're talking to students a lot. You're probably hearing from students a lot. And I'm just curious what you're learning, or if sort of how you're thinking about the U.S. economy has changed at all as you've been having more of these kinds of discussions.
Yeah, Purdue is one of the leading technology universities in the nation, and a lot of the assignment for me here is to combine the business school with the success of Purdue Engineering, #4 in the nation, and will turn out the most engineers, I think, in the coming year in North America here. So it's all about AI. It's all about technology. What's next in the world of technology, and how does that impact the world of business? Much like your program here, trying to wrestle with the issues of, tech has eaten the business world a long time ago, and now we need to figure out how can we assess the technological landscape, and how can we get students prepared for this new reality, or newer reality of technology and business.
Yeah, something that we grapple with all of the time as well, Jim. Thank you so much for your time today. Appreciate it.
Sure, happy to do it.
And be sure to tune in later for an exclusive interview with Federal Reserve Bank of Boston President Susan Collins. She'll be discussing her outlook on the rate cut trajectory in the 4 p.m. hour.
And on the other side of the break, Boeing CEO Dave Calhoun testifying before a Senate panel this afternoon. We're going to break down what's ahead for Boeing and get you caught up on some of today's top trending tickers. Stay tuned. More market domination after this.
Outgoing Boeing CEO Dave Calhoun testifying in front of a Senate subcommittee today and addressing the safety culture at the company.
Much has been said about Boeing's culture. We've heard those concerns loud and clear. Our culture is far from perfect, but we are taking action and we are making progress. We understand the gravity, and we're committed to moving forward with transparency and accountability while elevating employee engagement every step of the way.
Joining us now is Bill George, former Medtronic CEO and author of True North, Emerging Leader Edition. Good to see you. So as we listen to Calhoun's words there, do you think he sort of accomplished what he set out to accomplish and what he should be accomplishing as, for right now, the leader of Boeing?
Honestly, I wouldn't want to be in Dave Calhoun's shoes today, Julie. This is a very tough situation. It's a no-win situation because Boeing has so many problems that are not being addressed that there's no way he can win this. And they haven't really gone back to their first fatal mistake was to redoing the Boeing 737 instead of launching a new aircraft. So he's doing the best he can, but it's an ugly scene there. And it's probably going to get tougher.
Well, let me ask you, Bill. Let's say I made you CEO, and you've got the job now, Bill, right? Okay, congrats. What would be your priorities, your strategy? What would be the Bill George playbook for turning around Boeing?
Well, number one, first of all, I think you have to appoint someone who has an aeronautical background and has the courage to transform the company. But number one, move the company back to Seattle. That's its roots. That's its culture, and by abandoning that, going to Chicago and now Arlington, Virginia, it's been a horrible mistake. Second, they haven't had a new single-aisle aircraft in 60 years. Don't you think that aeronautical engineering has shown us new ways to design aircraft? They have new engines, new avionics, but they need to design a whole new aircraft. Yes, it'll take 7 to 8 years, but they've got to do it. And then third, it's not just fixing the instance quality problem. You've got to revamp the entire quality and supply chain. They farmed out the fuselage manufacturing to Spirit Aero. That was a big mistake. They've got to reinstate top to bottom a quality culture. People that just try to fix individual quality problems will always have more that pop up somewhere else. It's like whack-a-mole. So they need to get at that whole culture. And I think that's the key things they have to do. And I don't see any way around that. It's going to take time, and they're going to have to keep their customers in line until they can do it. But it will not get better until they go back to the original Air, which was refusing to design a new aircraft 20 years ago.
Bill, how the heck are they going to find a new CEO, right? There's now these reports in the Wall Street Journal that several people have said they're not interested, including reportedly Larry Culp and Dave Gitlin, and there are some issues with internal candidates. So is it a hard post to fill, given, as you say, you don't envy Dave Calhoun? It's a tough job.
I said on your show several months ago, Larry Culp would not be interested in the job. He's got a great job running GE's jet engine business. No, they've got two people that could do the job today. Pat Shanahan, who is CEO of Spirit Aero, former Deputy Secretary of Defense, worked with Boeing. He's an aeronautical engineer. He could do the job. Steve Mollenkopf, the chair of the board, could step in. He's got at least a technical background. And so I think one of these people should do it. I empathize with Calhoun, but it's not going to get there. And you can't have someone that doesn't understand the depths of engineering. They had the right person 20 years ago, and they passed him over twice, Alan Mulally, who went to Ford and saved Ford.
Bill, how tough do you think it's going to be to for this company to really build back its reputation after the kind of missteps we've seen from Boeing?
Josh, it's going to be real tough. It's a 10-year process. They've lost the trust, not just of the airline manufacturer, not the airlines themselves or customers. They lost the trust of the flying public. And so people are always asking me, am I on a Boeing plane or I'm on an Airbus plane? Well, they shouldn't be asking that question. Boeing's got to regain it. But look, we have no choice. This can't be a GE. We're just going to phase it out. No, we have to rebuild Boeing. It's a national treasure. It's a great company. And by the way, the engineers and people there want to do the right thing. The real core problem, Josh, is that 20 years ago, they decided to focus on short-term shareholder value, like a lot of companies have, GE included, and they're paying a huge price now. They got away with it for a few years. Now the chickens have come home to roost. They can't just focus on shareholder value. The only way they can rebuild shareholder value is to build great aircraft. That's what's going to build it up again. So they have a total revamp. But you need a CEO with a lot of courage who can do that. It's not just pick this and pick that.
Bill, is it possible that one of the other solutions to Boeing is to not have a single national company that we rely on in the United States to build aircraft? Is it splitting Boeing up into pieces of some kind?
I don't think so. I think, Boeing has problems in space business. They have problems in military business. No, it's a great aviation company. There's a reason it can't be with the right leadership. The people want to do the right thing. They have great engineers. That's not saying they have to get rid of the engineers. They have had some problems moving manufacturing around. But no, I think they need leadership. It's all a question of leadership. They get the right leadership in there. And they've had the board is part of the issue. They've had 5 failed CEO appointments. They should look at themselves in the mirror and say, what did they do wrong? And how are we going to appoint the right person? Until they do that, and the board needs to step up and admit its own shortcomings.
Bill, always great having you on the show. Thanks for joining us.
Josh, thanks for having me on, and good luck to Boeing. I hope they can cover. We have to have them do it.
We'll have you back to discuss. Thank you, Bill.
Thank you.
Let's get to some trending tickers. First up, Super Micro Computers, the company announcing it is adding 3 new manufacturing facilities in Silicon Valley and globally. The company says it is adding factories to support the growth of artificial intelligence and enterprise rack-scale liquid-cooled solutions, noting a demand increase. Obviously, we talk about this name a lot, Julie. The run on the stock, it's up about 225% this year. And you might think, well, maybe I missed my chance. Not according to the analysts who cover it. They're still very bullish. 12 buys, 5 holds, 1 lonely sell out there. And, as we've discussed, bulls like it because their bet is the AI server market is only going to get bigger, and they believe this is a company that's very kind of competitively positioned to take advantage of it.
Yeah, I guess so. I mean, either that or they just mention something AI and they go up, right?
Just sprinkle a little AI dust on something.
a little liquid cooling, right? I mean, and just for people who don't know, when you're looking at a data center that has a bunch of these racks that have AI components in them, which is a combination of chips and servers, et cetera, they get very hot. They use a lot of energy and they get very hot. You can cool them with air. You can cool them with liquid that sort of runs through tubes through the server rack. So that is what Supermicro is now talking about, expanding its manufacturing capacity for those liquid-cooled systems. There's something else I noticed, though, which is that if you look at the correlation between Supermicro and Nvidia, it's pretty high correlation. In other words, when Nvidia goes up, Supermicro tends to go up. I was looking at the two. The correlation got as high as something like 0.8, and 1-to-1 is the highest correlation you can have. So they do tend to sort of move in tandem, even when there's not necessarily big news on Supermicro. Nvidia tends to be the one that kind of the tail the
way. You had some Nvidia news today, though, too, which you're about to share with us.
Yes, exactly. Well, we're talking about, this is more HPE news.
Well, it's a partnership.
It's a little bit of both. Hewlett-Packard Enterprise is what we're talking about here. The company announcing it's teaming up with NVIDIA to offer a set of integrated AI hardware and software tools for its customers. HPE not up very much, though, on this, despite trying to sprinkle that NVIDIA pixie dust, so to speak. You know more about this deal than I do.
Well, I know more, but listen, it sounds kind of wonky. So I did call our Patrick Moorhead, tech guru, friend of the show, and I wanted Patrick's take. And basically, here's how he explained this: if you're a company and you want to create your own internal private AI system, you could now turn to HPE and NVIDIA for help, and basically go to them and say, listen, I need the software, the hardware, the services to do it, and that's what they're going to offer you. They're going to offer you the full stack. And I sort of asked Patrick, okay, bottom line, what does that actually mean for investors? Like, you're in NVIDIA. He actually said for NVIDIA, this is pretty good news because, in his opinion, we should mention, he's at HPE's conference in Vegas where this was announced. As Patrick said, he was in the audience and he said, this is a pretty, at least on paper here, this sounds like a pretty smart, simple, and comprehensive way for Jensen Huang to get his tech into the enterprise. We know he's in with those big cloud giants, but now with this, he said, helps him maybe give him more of a foothold in the enterprise as well. He also did think it was good news for HPE, again, at least in theory, the idea of it, because again, it's sort of comprehensive offering. We'll have to see what is the positive financial impact. we'll find out.
Yeah, well, HPE shares are up this year, but not as much as Nvidia, for example. They're up like 30% or so.
Although reporting had a nice rip off that report. Yeah. All right. And make sure to tune in to Market Domination this Thursday when we'll be joined by Hewlett Packard Enterprise CEO Antonio Neri. See, Julie, can ask him all those very questions.
Sure. All right. Still to come, shares of Dell are soaring again today as one analyst points to future AI opportunity. We'll talk about some of the top calls of the day on the other side.
The 10-year Treasury yield falling today and has been up and down this year with concerns surrounding rate cuts. Our next guest says despite ongoing volatility throughout the bond markets, investors should still consider moving back into fixed income. For more, let's welcome in Steve Lapley, BlackRock's global co-head of bond ETF. Steve, always good to have you on the show. Steve, actually, we haven't had the chance to catch up in a bit, so maybe we'll start with your views on the Fed. I want to hear what you're thinking there, Steve. Obviously the Fed, projecting one cut this year, Steve, maybe September, December. What are your views? Does that sound reasonable to you, Steve?
Yeah, Josh, thanks for having me. It's interesting, right? Because the market is now pricing in almost two full cuts. Whether that comes in September, December, we're not really sure, but the Fed clearly is trying to push back on that. You've had a number of speakers today basically advocating patience, suggesting that cuts may come later in the year. One speaker was even suggesting they may need to see quarters of better inflation data before they're convinced. But look, I think the bottom line is that we've seen yields kind of bounce around here. Last year we were heading back up towards we did touch 5%, dropped all the way down below 4, started heading back up to 5. Now we're around 420, 425. So the point is that it's going to be really tough to call the peak here. And we think it's really time to start thinking about reallocating to fixed income. So it's been very attractive to sit in cash at 5, 5.5. But at some point, this market will move. And we think it's time to start upping your allocation to bonds.
I mean, Steve, it's also been attractive to be in stocks, right? I mean, so we've definitely seen people, yes, allocate to cash, but yes, they want to keep liquid so they can jump in when they see opportunities in the stock market. And we've still got, I mean, we've been talking this week about Wall Street strategists who continue to raise their forecast for the end of the year for equities. So when you talk about, competition for allocation here, are you also having that conversation that equities are as much competition?
Yeah, there's some of that. I mean, investors obviously are going to have different risk profiles, but what we do know from our internal data is that investors for, balanced portfolios are fairly underallocated to fixed income. And that makes sense if you think about the last decade of very low rates. Going into this tightening cycle, you saw, some of the most challenging bond markets in, the last 20 years. But right now, you're looking at yields that are higher than they were in 2004. So this is a tremendous opportunity to right-size your portfolio. So yes, some investors will prefer to be, risk on and have majority equity, but we still think there's room to balance out that allocation. And right now, yields are very attractive.
Let me ask you this, Steve. Let's say I'm listening, I'm a viewer, I'm listening here, and I'm really in that sort of soft landing camp. We were just talking to Jim Bullard. He's in that camp. Let's say I believe that. That's my thesis. How do I want to be invested in fixed income? What would my basket look like?
Yeah, we're seeing investors actually allocate this way. So we're seeing flows into broad, multi-sector funds. Think AGG. That's capturing a lot of it. Also IUSB, which is adding in high yield and EM. But I think what we're also seeing is investors continue to allocate to high yield in general, either through broad high yield. We have a defensive product, HYDB. So that's investors sort of hedging there in case the credit cycle becomes a little bit sharper than they were expecting. But today we just launched our active fixed income high yield fund, BRHY. And so that provides investors the opportunity to kind of allocate between index and active to create a more resilient high yield exposure across both of those. So high yield is going to be a part of that if you do believe in the soft landing.
And I know that there has been an uptick in active ETFs. Were you hearing a lot of demand from your clients for that kind of a product?
Consistently. And I think, this is what we view as sort of the total portfolio. It's not necessarily that everyone's swinging back to active away from index. It's that investors are demanding high-performing active strategies within the ETF wrapper for things like model portfolios, as an example. So we continue to hear this very loud and clear from our investors, and we're responding. Right now, in the U.S., in active fixed income, we have $13 billion across 11 products. We've talked about BINC, B-I-N-C. That product is now $3.2 billion and growing. Our CLOA fund is growing as well. So we continue to put the pieces on the table to build out that active fixed income suite. Again, investors can use this alongside of index building blocks to really create a much more resilient portfolio.
Steve, always good to have you on the show. Thanks for taking the time to chat. Appreciate it.
Thanks for having me.
Now let's get to some calls of the day here. BofA Securities coming out with a new note today on Dell, maintaining its buy rating and noting sovereign AI demand as a large future opportunity. Nice pop in Dell. This is interesting, Julie, because Dell reported, and then remember the stock sank. But now the street, we're getting this kind of consistent flow of bullish notes, obviously exciting investors. The latest is Bank of America. The analyst there is Wamsi Mohan, smart guy, does good work. He hosted investor meetings with CEO Michael Dell, CFO Yvonne McGill, says we walked away confident in the multi-year opportunity related to AI, he says, talks about how AI server margins, and of course that was a big sticking point when Dell last reported it. Investors were disappointed, but Wamsi arguing that those margins have runway to grow over time. investors clearly like the sound of that.
Yeah, and he's confident enough. He's got the price target of 180 on the shares. And you talked about the stock pulling back a little bit after the earnings and then bouncing again. I mean, it's still just about doubled this year.
Incredible.
So even with that pullback post earnings, it has still seen this big increase here. And just like the note we were talking about yesterday on Dell, the price target increase there. Again, this talks about demand from cloud service providers, as well as enterprise AI, kind of driving this cycle, and also that margin tailwind that you talked about as well.
Yeah, bulls coming out, pounding the table.
Yeah. Let's also talk about Micron. Stifel raising its price target on Nasdaq from 140 to 165, citing tailwinds from AI demand for high bandwidth memory. And that has been sort of the bull case generally for Micron, right? We've heard a lot about what they call HBM, high bandwidth memory, and that is the catalyst here. And the analysts are also talking about increasing in pricing for memory, and that it's going to be driven by some of these more complicated memory chips. Memory chips, of all the chips, I mean, they're definitely commoditized. Most of the chips are commoditized, except for Nvidia's new, very complex ones. But it's interesting to see this evolution of the memory industry to these HBMs that are a little more complex.
Yeah, the HBM is what's got so many people excited. And remember, Micron reporting coming June 26, those earnings hit, and the analyst saying that he's increasing his estimates toward the upper end of that guidance range on this better memory pricing. Also raised, it looks like his Q4 estimates, expects favorable pricing to persist in NAND as well. So, and says, by the way, he views Micron as AI GARP, Julie.
I love GARP.
AI GARP, growth at a reasonable price. Yeah. So we'll see June 26, circle your calendars. All right, moving on. Citigroup CEO Jane Fraser speaking out earlier, telling investors the company is no longer the financial supermarket of the past. Here with more is Yahoo Finance's own David Hollerith. David.
Hey, Josh. So today was about Citigroup's services business, which is kind of a lesser known part of its business of the bank's massive international operations. And the point of it is to basically help multinational companies move money across the world. But Fraser also made a point of outlining how this investor day, even though it's just one part of the business, was also meant to refocus on what's looking like a new Citi, a new version of the bank. And the context here, obviously, is that CEO Jane Fraser laid out ambitious goals in 2022 to essentially right-size the bank. Citigroup has been lagging peers for years. And so a lot of the efforts over the past year has been about restructuring and reorganizing and downsizing Citigroup's business. Services is sort of a business they have not highlighted yet. In some ways, it's a little bit dull to the average person, but it's actually a huge asset for Citigroup in that it has sort of scale of working with multinational companies, and also the amount of countries that it operates in, to the point where it's kind of something else that no other Wall Street bank can really offer. So those two things were on the table. As far as financial updates from the bank, they kept their targets for 2026 and for the full year. For the second quarter, they are expecting slightly lower net interest income. They're also expecting a 50% increase in investment banking fees. That's compared to last year. So a big boost in investment banking fees for the second quarter. But tying all of this together, the financial supermarket was what really originally formed Citi in the 1990s. Which came out of a conglomeration of businesses. And so Fraser came out today essentially underlining the fact that she's dismantling that for a new vision of Citigroup.
Well, we shall see if it ends up paying off. Dave, thanks a lot. Appreciate it. Still to come, it's the Yahoo Finance Investor Playbook, the impact of climate change on insurance. Insurers have exited some states and raised rates in others. We'll get one take on how you should invest in that sector. Stay tuned, more market domination on the other side.
America's homeowners facing a hefty price tag from climate costs, and now the fallout from severe weather risks may be spreading in the U.S. Yahoo Finance's senior columnist Rick Newman joins us now with more. Rick.
Hey guys, yeah, I've been looking into what is happening with homeowners insurance premiums. We know people have been getting walloped with huge increases in auto insurance costs, and something similar is happening with home insurance premiums now. And I think part of the surprise here is we expect this to happen in coastal areas and places that are exposed to extreme weather, the type that's familiar to us. But this is happening all across the country for a couple of reasons. Number one, weather is just getting more extreme, and extreme weather is getting more frequent, and that is happening everywhere. So, for example, in the upper Midwest, they've had a lot of hailstorms in recent years that have caused a lot of damage. So that is pushing prices up in states like Minnesota and Wisconsin. And the second thing that's going on here is because big national insurers, because they write insurance policies across a huge pool of buyers all across the country, to some extent they are offsetting super high costs in places where there are severe storms. Think Florida, California wildfires, Tornado Alley, things like that. Those are getting worse and they're getting more expensive. So they're having to raise prices in some other areas just to offset those costs. And if you think this is price gouging, not really, because when you look at the profit ratios or loss ratios of insurance companies, they have been losing money on insurance policies in 17 different states during the last 5 years when you average it out. That's compared with just 7 states where they were losing money going back to the 2014 to 2018 timeframe. So this is becoming a bigger problem for insurers, and it doesn't matter if you believe in climate change or not. This is showing up on the bottom line of insurance companies, and they are either raising rates, reducing coverage, or getting out of markets altogether, and that's going to affect many, many Americans.
Indeed, and it already has in many cases as well. Rick, thanks so much for that. That is the perfect setup, because we're going to continue talking about this and the effect on insurers around the world. Extreme weather is intensifying. A powerful heat dome is settling in over the eastern half of the country as the Gulf Coast faces flood risks from possible tropical systems, and wildfires threaten the west. With extreme weather comes extreme insurance premiums. But how much of an impact will it make for investors? We're taking a look in the Yahoo Finance playbook. And joining us now is Kathy Seifert, CFRA Research's Vice President of Equity Research, who's looking at this. Kathy, it's good to see you. This is a really interesting topic. We just heard Rick talking about the effect that it's having. So sort of big picture here, are insurance companies far and wide rethinking where they can operate and how they can operate because of changes in weather?
Yeah, I mean, that's a really good question. And your previous guest really sort of, teed things up nicely. And just to kind of, by way of a little bit of background, we're now 6 years into a hard insurance pricing cycle. And this is something that's unprecedented. The insurance industry really has not seen this kind of pricing power in decades. And I would argue that this pricing power that the industry currently has is likely to be a secular trend, not a cyclical trend. This is good for insurance investors. I think you have to choose carefully depending upon a particular company's strategy, how well they've historically underwritten, and things like that. But within the homeowners and the personal auto lines of coverage, the industry has not made a profit in quite some time from underwriting. There are a handful of companies that do, but for the most part, those lines of business have been unprofitable. The way I think to play this is to pick names of those insurers who have pricing power, but either have a diversified book of business so that they don't have outsized exposure to one particular line of coverage or one particular area, and also have lines of coverage that is not necessarily as exposed to severe weather. So, along that score, I like Arch Capital. They're a reinsurer and a primary insurer. They don't necessarily write a lot of catastrophe reinsurance. They're growing their top line mid-teens, which is faster than the overall industry. I see the broader industry growing around 7 to 10% this year. We thought that things were going to soften a bit in terms of pricing. The first quarter numbers from the commercial lines insurers showed us that premiums were up almost 8%. And a lot of that is driven by the same things that's driving the personal line space, and that is commercial property that's impacted by weather, and commercial auto, which is impacted by a lot of the same things that impact personal auto. So I like Arch Capital. I also like AIG. They're in the throes of a restructuring, and I think they've done an admirable job of reducing the risk profile of their property casualty book of business, while at the same time cleaving themselves in two, as opposed to being a multi-line insurer. They're now AIG, a property casualty insurer, with Corebridge, a life and annuity, or life and retirement insurer, and they're in the process of deconsolidating. Actually, they just deconsolidated Corebridge. So that's a turnaround play. In the personal auto space, I think the best underwriter is Progressive. They have best-in-class underwriting analytics, the capabilities, the analytical capabilities, the ability to write usage-based insurance, which I think is going to be an important competitive attribute as consumers look for whatever ways they can to save money on auto insurance.
Kathy, on Progressive, we just pulled up that stock chart. It's a nice move. I mean, more than 30% this year, Kathy, more than 60% in the past 12 months. Would you still want to carve out a position in Progressive now, or would you wait for a pullback?
So it's interesting. We talked about sort of severe weather, and this hurricane season is expected to be really active. What typically happens to the entire space when a hurricane hits is the stocks sell off because people get concerned about claims. So I think as we head into hurricane season, investors might want to be mindful of those kind of opportunities. I agree with you, though. I mean, Progressive, if you follow this industry, you tend to be a value investor. Progressive is a growth stock, and it sort of breaks the mold of the typical PC insurer. And honestly, I've hesitated with this stock because it never looked cheap enough for me. But then what I've seen over the last several years is Progressive kind of pulling away from the pack because of their really significantly superior analytical capabilities that are going to serve them better as the insurance industry continues to grapple with all of these climate change issues and the need to streamline underwriting and get a more cost-effective underwriting model to offset the rise in claim costs. And Progressive's kind of already there. Geico and Allstate are still playing catch-up. However, I think Allstate's an interesting turnaround play. There's some execution risk there, but I think they're attractive.
Interesting.
Yeah.
Kathy, I wish we had more time, but listen, great strategy, great picks. We appreciate you coming on the show.
It was great being with you.
Thank you so much.
Take care.
We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell.
And be sure to tune in later for an exclusive interview with Federal Reserve Bank of Boston President Susan Collins. That's at around 4:40 p.m. Stay tuned for Market Domination. Jared Blickery will be back too, right after this. That's the closing bell on Wall Street, and now it is market domination overtime. We are joined by Jared Blickery to get you up to speed on the action from today's session. Let's start with where the major averages ended on the session. All three in the green, actually. The Dow finishing higher after, you can see, kind of bouncing between gains and losses throughout much of the session, but up by about 57 points when all is said and done, 0.1%. The S&P 500 closing higher by 0.25%. That means another record close. And the Nasdaq, is it 7 in a row now that we've got record closes for the Nasdaq Composite, even though very barely making that today. Let's look at a quick 10-day chart, of the Nasdaq, and you see that 6% move upward. Yesterday we were talking about how broad the gains were, and even though the gains overall are not as big today, they're just about as broad as they were yesterday. Both the S&P and the S&P equal weight index rising by about 0.25%, and the Russell 2000 right there as well, up about 0.5%. Well, let's send it over to Jared for a closer look at today's action.
Thank you, Julie. I think it is 7 days, and let's get to some heat maps here, and we can plot the action of what happened just today. Now, here's the financials in the lead spot there. XLF up 0.6%. Industrials close behind it, but not seeing a lot of outperformance to the upside or downside. For what it's worth, communication services, consumer discretionary materials, all of those closed in the red here. But what we're looking at, what everybody's looking for, is to see the pecking order. And guess what? Nvidia is the biggest stock in the solar system again, actually for the first time ever, not again. It has passed Apple again because it did that last week, and you can see it's up 3.5%. I'll give you the market cap numbers, $3.335 trillion for Nvidia, a little bit less for Microsoft, and a little bit less than that for Apple, but those are the behemoths right there. And if we take a look inside what's happening in the semiconductor cycle, or I guess circle here, we got a bunch of record closes. Nvidia, also KLA, Qualcomm, and maybe one or two others, but we've just seen this flurry of action inside the semiconductor space. And looking a little bit different in software, we are seeing some outperformers. Oracle up 2%, but for the most part, you're seeing more downside action than upside, and that's kind of what we've been seeing. More outperformance by the semis than just about anything else. I'm going to close with our leaders here. You can see a lot more green than red. Number one is the SOX. That's a semiconductor index, which, by the way, closed at a record high. The worst performer is Bitcoin, down about 3.5% there.
All right, thank you, Jared. A record day on Wall Street for the Nasdaq and S&P 500, just barely, and it's official. Nvidia overtaking Microsoft as the world's largest company. And joining us now is Ahmed Riesgo, Insignio Chief Investment Officer. Ahmed, it is good to see you. So, Ahmed, we were talking to Jim Bullard today on the show, former Federal Reserve Bank of St. Louis president. Now Jim still firmly in that soft landing camp, but you actually see an economic downturn coming, Ahmed. How come?
That's right. Listen, last year, I think when most analysts were expecting a recession, we were firmly in the camp that we just didn't see recessionary conditions in the United States. This year, we think it's a different story. We think just as everyone is coming over to the no recession side, the soft landing side, we think the chances of recession are much higher, not only than Wall Street expects, but that it's currently being priced in by markets. So we don't think it's a done deal that a recession happens in late 2024, early 2025, but we do have a lot of warning signs that things are deteriorating rather rapidly, especially in the labor market. I know that's not being reflected in the employment data, but we're seeing it in other labor market data, especially on the demand side. Strangely enough, the market's now pricing in no recession, which means that from a market perspective, we just don't think that this is an attractive place to deploy new capital into the broader market, given that it's almost perfectly priced for a soft landing scenario.
Ahmed, can you be a little more specific here about what signs that you're seeing, both within the labor market and elsewhere, that would point you, that we're getting closer to a recession?
Yeah, so it's mostly coming from two different, let's say, types of data. One is labor demand. And what we're seeing there is that the demand for new hires, for new jobs, is falling quite rapidly. And in fact, if you extrapolate current trends for labor demand, we think that the unemployment rate will probably start shooting much higher sometime by the end of this year. That's if things continue on their current course. The other area where we're seeing a lot of weakness is in the U.S. consumer, and we're seeing the U.S. consumer becoming a lot more discerning as to where they want to deploy new dollars. We're seeing it being reported by retailers such as Walmart and Target that consumers are, for the first time in a very long time, opting not for higher priced goods and instead are focusing more on staples and lower priced goods. So we see that the consumer is starting to behave as their wallet is getting pinched. This is something that many people expected to happen last year. It didn't happen because those U.S. excess savings were quite large, but we're finally starting to see it come in. And if you couple that with deteriorating labor demand, which eventually will lead to layoffs, it doesn't look good as far as a U.S. recession is concerned.
And Ahmed, when you talk about a recession, economic downturn, can you quantify that for us? How significant are you looking for here?
So we don't think it's going to be a very significant one. That's definitely a big difference versus the last two recessions. The last two recessions we've had in the United States have been strong exogenous shocks to the system. We don't think that's going to happen this time around. This is going to be a very mild recession. In some parts, it might not even feel like one. Basically, this is a recession where we expect the unemployment rate to go higher than where it is right now. So to tick above 4%, but not tick above higher than 6%. So a very mild recession, especially compared to the two most previous recessions in the United States that have been quite significant shocks to the system. And obviously there I'm talking about the GFC back in 2008 and then COVID in 2020.
Well, given that it's going to be more mild and given that the rally has been led by large cap tech, is there a scenario in which they could just keep going up, even if there is a mild recession here, if spending holds up in areas like AI, for example?
We actually think you're exactly right, which is actually what we're telling investors to do, is to kind of adopt a sort of barbell strategy where you still have on the one side exposure to what we like to call now defensives, because that's what's happening with mega cap tech. They're actually defensive and growth. They're this hybrid, sort of new hybrid sector that's popped up. These are companies that are doing well under every scenario. If there's economic boom times, they're making money. If things are going bad, they're still making money because they're almost trading like utilities. Think about this right now. If you're a company in the United States or even elsewhere, and let's say we do head into recession and you need to cut spending, you are more likely to cut headcount than you are your cloud service, right? Because these things are really becoming a utility. They're necessary. They're exactly like paying the electricity bill was, 20, 30 years ago. So we think they're actually going to do well in both types of environments, both booming growth and recessionary conditions and scenarios.
What about materials specifically, Ahmed? How come you believe that that's an area to commit capital to?
Right. So we actually think that that's a good hedge in case we're wrong and in case we're still going to continue along in economic expansion. What we're seeing is that there's a series of cyclical sectors out there that have not participated in this rally and that have a lot of space for catch up. And so if we're wrong and the U.S. economy, let's say, does not delve into recession, we think that those sectors will start to catch up to the other sectors that have been performing very well. And I'm talking about things like materials, things like industrials, financial, some of these other sectors that have so far lagged the more dominant parts of the market this year, like tech, utilities, and some of the more other defensive ones.
Ahmed, thank you so much. Appreciate your time.
Thank you.
Let's talk home builders now. Lennar sliding today after announcing second quarter earnings. The home builder citing the choppy mortgage rate environment as a headwind, as you might expect. Here with more, Yahoo Finance's own Danny Romero. So talk to us about not just Lennar, but what it tells us about the housing market.
There was actually some very interesting commentary from Lennar that talked about what the current consumer is feeling right now. And they said first, number one thing was consumers are feeling a bit distressed. And so that is creating some credit challenges who are trying to some way jump into the housing market. They said that that is similar to last quarter. Another key thought that I thought was very interesting from this earnings was that consumers are very sensitive to the interest rate movement. So there is a direct correlation when interest rates go up. That means builders would most likely offer some form of incentives like those mortgage rate buy downs. They'll probably boost those up. That's when the builder upfronts the cost to lower the rate on the loan. And third is that consumers in a way are expecting a discount and incentive to afford a home. And I thought that was really interesting that consumers are expecting some form of an incentive when buying. And then in the second quarter, Lennar did cut home prices. So we could see that in the next upcoming earnings with KB Home. The average sales price for a home for Lennar was about $426,000. And that was a 5% drop from last year, Julie. So another thing that they did reveal in this is that the Fed rate cuts, if that does materialize, will that be some form of competition for them, or it will also boost the housing market in general? So they're not too worried about or concerned that would cause some form of extra competition. They're pretty bullish that they're going to.
It would be good news for them also.
Totally, but then there's more homes for sale, right? So then you're competing with the resale market and then the new home market. But Lennar was very bullish in saying we're not too concerned that if it does unlock more inventory, that it would cause a problem for them.
Interesting.
It was, Dan, I was talking to Jay McCandless over at Wedbush, who covers these names in the sector, and he is great. And I sort of asked him the same question, kind of, what is just, as a financial analyst who just lives in this world, what does just the broader environment look like? And he kind of painted a sort of a continued mixed picture, because he said demand was still there, like the demographics still work, because you have so many. Just think Gen Z, millennial Americans, they would love to buy a home. But on the other hand, he said affordability is still such an issue. 30-year fixed, 7.02% still, according to Mortgage News Daily. It remains a challenge.
Well, and the other thing that we have to consider too with the existing home market is that homes that are 40 years or older, they don't have an entry-level price point. So that's why it really does make it attractive to jump into the new home market, because you're going to be offered some form of an incentive, whether it's the buy downs, whether it's the closing costs, whether it's the home price cut. It really makes it attractive when you are an entry-level buyer. And for KB Home, who's about to report earnings, they are specifically focused on first-time home buyers. And so that really does kind of signal across the board for all home builders. They've kind of changed their focus. They're kind of like, you know what, let's try to help the entry-level buyer right now. But yes, I think that, inventory still remains limited. Builders have been ramping up housing starts. So that looks really attractive right now for the market. To really fulfill the gap that's going on between both markets.
All right, let's get to KB Home, because the numbers are out here. Second quarter results hitting the wire. So second quarter earnings per share, $2.15, well above estimates. Second quarter revenue falling year over year, but coming in ahead of estimates at $1.71 billion. The same goes for deliveries, which again fell on a year-over-year basis, but were ahead of estimates at just over 3,500. The company is now bringing up the lower end of its full-year revenue forecast, now expecting $6.7 billion to $6.9 billion in revenue for the full year here. The company's average selling price did increase year-over-year to $483,000 from $479,500. Again, on a year-over-year basis. And the CEO, Jeffrey Mezger, the chairman and CEO, saying in the statements the key metrics are above the high end of the guidance, and buyers are resilient in their desire for home ownership despite the volatility in mortgage interest rates that you just pointed out, Josh. Despite 7%, people still want to buy houses.
Yeah, look at that nice pop in the after hours. It's interesting. The CEO here, a business generates substantial cash flows. He knows we're continuing our balanced approach in allocating this capital, focused on both expanding our scale and returning cash to our stockholders, Danny.
The other thing I thought was really interesting, it says our pace of monthly net orders per community was one of our highest second quarter levels in many years. So that really does show the appetite that there is for this new home market. But if you compare Lennar's price tag of $426,000 to what KB Home did, it was $483,000. So you can definitely see a little bit of the range there when it comes to home pricing. But we also have to consider that KB Home, they build homes in Arizona, California, Florida, Idaho, Nevada, North Carolina, South Carolina, and Texas and Washington. So some of those states are definitely higher home prices up in those ranges. So we have to factor that into all of this. But again, he just said it. It remains, buyers remain resilient in their desire for home ownership. And I think that nails it on.
Yeah, definitely. And they expect the average selling prices for the full year to be 485,000 to 495,000. So a little bit of a tick up from this quarter. Thanks a lot, Danny. Appreciate it. Well, still to come, we're checking in on the latest from Boeing following today's comments from CEO Dave Calhoun in front of Congress.
But before we go to break, Signet reported last week, we hit it on air. I suggested the CFO had gone off script during the conference call, and the company reached out to us to say that was not the case. More market domination overtime coming up. Outgoing Boeing CEO Dave Calhoun testifying in front of a Senate subcommittee today. But before he took questions, he apologized to the families of the victims of Ethiopian Airlines Flight 302 and Lion Air Flight 610.
I would like to apologize on behalf of all of our Boeing associates spread throughout the world, past and present, for your losses. They're gut-wrenching. And I apologize for the grief that we have caused. And I want you to know we are totally committed in their memory to work and focus on safety for as long as we're employed by Boeing.
Yahoo Finance's Praz Submarinian has been following the hearing today. Praz, what do we hear?
Yeah, you know, that was a little surprising when Calhoun stood up in the middle of his prepared remarks to address those families there. And there in the beginning, that before he even started, they were chanting and complaining and voicing their displeasure with Boeing and how they hadn't really kind of been punished yet for what had happened. So that kicked off the hearings there, and a number of senators kind of grilling Calhoun here about what happened here with regards to, you know, how can you reassure us something has changed, safety culture has been improved. Calhoun saying that something went wrong with regards to whistleblower intimidation, acknowledging that had happened, and said that they had fired and disciplined some managers who had sort of intimidated whistleblowers. We just had one last night talking about how non-conforming parts were used on some MAX planes, and Boeing tried to hide that fact. But you know, beyond that, I think Calhoun was just there to sort of kind of take his lumps from these senators. He took some pretty big ones from Josh Hawley. senator from Indiana, talking about how maybe Calhoun was one who came out on top through all this.
You're getting paid a heck of a lot of money. It's unbelievable. If anybody's come out of this deal good, it's you. Why haven't you resigned?
Senator, I'm sticking this through. I'm proud of having taken the job. I'm proud of our
this
safety record, and I am
You're proud of
very
this safety
proud
record.
of our Boeing people.
You're proud of this safety record.
I am proud of every action we have taken.
Every action you've taken?
Yes, sir.
Wow.
Hawley also brought up the fact that Calhoun had said that he's proud of the safety record and things like that and processes. And he said, well, are you proud of the fact that some suppliers were using Dawn dish soap and hotel credit cards to fit some parts in together, bringing that up? Those allegations of, believe work that had happened at Spirit Aerosystems. So kind of some fireworks here and there, but really sort of Calhoun is sort of absorbing a lot of heat.
Right. Well, and he was asking why hasn't he resigned, but he is stepping down at the end of the year, and Boeing, of course, is in the process of looking for his replacement. Pross, thanks very much. Appreciate it. Well, the outgoing Boeing CEO testifying in front of lawmakers earlier today about the safety culture at the company. Boeing is the #1 holding in our next guest's commercial aerospace and defense ETF. For more on Boeing's path forward and what it means for investors, we're bringing in Tony Bancroft, portfolio manager at Gabelli Funds. Tony, it's good to see you again. So, obviously, whenever you get a congressional hearing like this, you get some political grandstanding, of course, but we also got new whistleblower revelations today with regard to Boeing and about the quality of the materials that it has been using. What's your level of concern about whether Boeing is getting back on track?
Thanks, Julia. It's great to be back. And Josh, I think Boeing coming to this meeting today, CEO Calhoun knew he was going to take a grilling, shows they're committed to transparency and obviously what they've discussed with and put out and which the FAA has agreed upon. They've got a lot of work to do. They've got a long way to go, but I think they're committed to it. And I think it's sort of more of a long-term story. I think right now, Boeing's in the process of sort of rebuilding the culture and working on their QA and safety practices, and it's going to take time. It's just not going to happen overnight. The stock's probably just not going to react until we see a new CEO, the Spirit deal closed, and you start seeing production rates in the 737 increasing. But we continue to like the stock. It's a #1 holding in our Gabelli Commercial Aerospace and Defense GCAT ETF. And I think the long-term secular, thesis, the tailwinds for Boeing remain intact, and you're going to continue to see them improving their quality, their operations, and production rates, and you're going to probably see a year or two from now a better company.
And Tony, you mentioned a new CEO. Who do you think that new CEO should be, Tony? Do you have names of candidates you'd like to see take that big seat, or at least more generally, Tony, the kind of background, experience, skill set you think that next CEO needs to have?
Yeah, I think I'm sort of in line. I've spoken with Boeing, and they sort of have what they call their wish list. Someone that can essentially usher in the next plane. The 737 MAX won't be around forever, and they're going to need to design a new aircraft that's more efficient and has worse safety features, ESG friendly, you name it. And so they're going to need someone that has the engineering prowess to do that. They're going to need someone who can sort of work with Boeing's culture and sort of their employees' hearts and minds to sort of improve that aspect of the business. And they need someone with a technical, sort of engineering, operational background that can, that understands production, supply chains, production, production lines, and can improve the efficiency there. And I think the logical person would be someone like Pat Shanahan, the CEO of Spirit Aerosystems. I think when they get this deal done, there could be an announcement that he takes over as CEO. Former CEO or former Boeing employee, has CEO experience, engineering background, has worked in government. I think he sort of hits all the wickets.
Tony, I know that you are confident in the company's sort of transparency that we have seen, right? But I have to wonder, were there problems in past years that we just didn't know about and now we know about them? Or are there more problems now? Maybe that's difficult to know. It just seems like there are issues here. It's not just that they're being more transparent. It's if we're people flying on a plane that is a Boeing, it seems like there are some areas of concern.
Yeah, I think Boeing is just like any other large corporation, and obviously, nobody's perfect and no corporation is perfect. I'm sure if you went to any Fortune 500 company in America and put the spotlight on and the microscope that Boeing has on them right now, you're going to find issues. And I don't think, Boeing is self-admittedly no different than that. But if you will look at the big picture, the safety record that the FAA has upheld for the last 15 years, not a crash-related mishap that's in turn had a death on an FAA aircraft. It's just Boeing's essentially a victim of its own success. I mean, they're 51% of the FAA fleet, so they're the mass majority of what is flying safely. Every second or so, someone's flying in a Boeing aircraft, and I just think that Boeing is getting a lot of heat right now. But the reality is it's the safest way by far still to fly or to travel, of any mode of transportation.
Tony, good to have you on the show. Appreciate you making time for us.
Thanks, Josh.
And time now for what to watch. The stock and bond markets, remember, are going to be closed for the Juneteenth holiday, but we will be seeing a bit of economic data tomorrow. The monthly home builder confidence index is coming out in the morning. Economists expecting that number to tick up a point to 46.
And looking ahead to Thursday, more data on the housing market. Housing starts and building permits are out ahead of the opening bell. Wall Street estimating both numbers to rise after declines in April. We'll also get the weekly look at mortgage rates from Freddie Mac, which fell to 6.95% last week.
And finally, on the earnings front, more reporting from Accenture, Kroger, and Darden Restaurants, among others. Kroger announcing first quarter earnings on Thursday morning. Analysts expecting same-store sales growth to be muted, facing inflation-related headwinds from price-sensitive consumers.
That'll do it for today's Market Domination Overtime. Be sure to come back Thursday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's asking for a trend. I got you covered for the next half hour with the latest, greatest market-moving stories, including an exclusive interview with Federal Reserve Bank of Boston President Susan Collins. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton. For the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. There is a new top name on Wall Street, Nvidia, eclipsing Microsoft today to become the most valuable public company, continuing its run after surpassing Apple's market cap earlier this month. The surging stock helped bring the S&P 500 to another record as AI enthusiasm shows no signs of slowing down. Plus, another crack in the consumer, weaker than expected retail sales, hinting at a possible economic slowdown and bolstering the timeline for rate cuts from the Fed. We're going to hear from Boston Fed President Susan Collins at 4:40 p.m. today in an exclusive interview. And in the meantime, those higher for longer rates have been placing pressure on the real estate market, and that is where we begin today. Real estate capital markets face a period of uncertainty as central banks move at different speeds with interest rates. Commercial real estate fear indexes remained elevated throughout March, not yet following the broader capital markets improvement, but real estate investment manager Hines says there's clear opportunities emerging across sectors. And joining us here to discuss is Hines Global Chief Investment Officer David Steinbach. David, good to see you.
Good to see you.
So you said something interesting in a recent interview, David. You were talking about real estate investing, and I heard you say in this interview, it used to be kind of like downhill skiing,
right,
and now it's more like cross-country skiing. Right. What did you mean by that?
Yeah, I mean, look, we've had 40 years of one interest rate environment, and that was rates were steadily going down for 40 years. And, the entire financial industry worked itself around that dynamic, right? And a lot of ways of working got deeply embedded in terms of how we finance, how we create capital stacks, how we create value, and frankly, what the scarce resource is. Downhill skiing to me is moving quickly, right? It's a bit of adrenaline, speed, having money
right,
fast, like that. Now
cross country, more work.
Yeah, more work, and it's a shift from beta to alpha.
Sweating a little bit.
Right.
Yeah.
It's a shift to beta to alpha, and I think in that world, it's about creating income. It's about the hard work of execution, and it's a different sport. It's a winnable sport, but it's a different sport.
I want to dive into one sector, particularly CRE, commercial real estate. Often when we talk about that sector, David, on this show, it's almost like I talked about like in hushed tones. It's like empty buildings, empty downtowns. No one's going back to work post-pandemic. Is that what you see?
No, there are buildings that don't work anymore, and certainly there are specific office buildings that are probably going to be torn down or find a new purpose. That is true. What's also true is the best buildings are performing quite well, and there is a real disconnect right now.
Are there certain regions or cities where you see better performance?
Well, certainly there are some geographies that are better than others, and certainly in a global context, office is very different in Europe and Asia as it is in the United States, and so there's a lot of diversity there you have to understand. But even within a city, it really matters about not only the location, but the quality, and real estate's becoming more of a service, and so it's about what you're doing for the customer, the tenant. That really is moving the needle now, more than ever.
So it's interesting, you would sort of push back then, because you'll sometimes see this story, listen, things are they're different. Downtowns aren't going to bounce back. It seems like you're kind of pushing back on that a bit.
Yeah, I mean, look, there are areas that, again, are struggling, but the downtowns, particularly downtowns that really activate multiple uses in terms of how they're bringing people in to them, those are going to outperform, certainly transit, things like that we all knew before are resonating still. I think the real opportunity is for owners to really think differently about how to play the game differently in terms of the sport, and how can they uniquely solve the customer's needs and do that in the context of the built environment.
I want to get you out here on this, David, quickly. We've stayed very U.S. focused in this conversation, but you guys are global.
Right.
So internationally, is there a market that excites you the most? Is it Europe, China, India?
So we're in 30 countries, about 380 cities around the world, so have a very global perspective on what's happening right now in real estate. And we're deploying capital all across the world. Last year was about a third Asia, third US, third Europe. For us, Europe definitely led the downward trail and has repriced the soonest. We're pretty active in Asia. Within that, Japan and Australia in very different places. China, we've had a business a long time. We've been much more focused on India the last year.
Why India?
It's chasing demand, and so a lot of the demand that we are serving has expanded. There's a lot of expansion plans that have been happening. So that's been a trend to watch. And here in the United States, I think as the deal activity is going to pick up significantly, I think credit is going to lead. Equity will follow right behind that. And certainly, I think right now in multifamily, it is materially different than it was a year ago. Retail is another sector that we are very interested in. The winners and losers have been sorted. And the best office is something that is going to look very different in a year. I think it's been oversold in terms of how capital markets are pricing.
All right, bring a little optimism to the show today. David, thank you so much. Appreciate it. Coming up this Thursday, it's the latest episode of Lead This Way. Here's a sneak peek as Madison Myles gets a closer look at the next AI revolution in healthcare.
The use of AI in healthcare has long been contested, with fears about data privacy, bias, and even ethical concerns about hindering doctor-patient relationships. Dr. Angela Shippey, medical doctor turned physician executive at Amazon Web Services, is hoping to make AI adoption a positive for patients and providers.
Can you imagine that you go to your doctor's office and instead of having the interaction be about saying, did you get this test, did you have that test, what other specialists have you seen? All of that's been summarized and is right there in front. So then the interaction is more about you saying, I see that you've had the following. It looks like you've already had the radiographic imaging that you need. You've already had the lab tests. Now let's talk about what the next step is. So that interaction is more, again, looking at each other and having true dialogue about what's next in your diagnosis.
And now over to our very own Jennifer Schonberger for an exclusive interview. Jennifer.
Thanks, Josh. I'm here in Lawrence, Massachusetts, which is about 45 minutes north of Boston, where I have spent the day shadowing Boston Fed President Susan Collins as she gathers information firsthand on the ground about the economy, talking to local businesses, banks, community developers, all information that she will use in her decision-making when it comes to setting interest rates. Susan, thank you so much for letting me tag along with you today and for sitting down with me. It's been great to be with you in Lawrence.
Absolutely a pleasure. I'm glad you could join us.
What did you take away from your conversations today on the ground, and how is that informing your outlook for the economy?
Yeah, and it's wonderful to be able to meet with so many different stakeholders from around our community. This is something that I think is really essential to understanding what's actually happening on the ground. You know, it complements the data that we look at and the analysis and modeling that we did. And one of my key takeaways was really understanding some of the challenges that the higher inflation that we had endured is creating, especially for smaller businesses. And the fact that labor markets are actually improving. It's getting easier for people to hire, and there's much less turnover. And so hearing from people who are on the ground firsthand, smaller businesses and larger businesses and community leaders, has just been extremely informative.
I do want to follow up on inflation and what you learned today, but first on the economy, given what you heard today and the comments from local businesses, how is that lining up with some of the cooler data that we got in terms of first quarter GDP on account of slower consumer spending? We got a retail sales number this morning was a bit more tepid, signs of some cooling in the job market. How are those two lining up?
So I think what we're seeing, I think they actually line up quite well. What I see in the statistical data is certainly evidence that the economy is coming into better balance. There's been some slowing in demand, but an economy that's still solid. But it's still quite mixed. There are differences across sectors, there are differences across regions. And what I heard today, it's very consistent with that in the sense of some firms that are still seeing quite strong demand and others where they're seeing consumers being a bit more cautious in terms of their spending. And so to me, that aligns quite well.
So the soft landing still in place?
Well, I continue to be that realistic optimist, optimistic that we're going to bring that inflation down, but we're going to do it amid a labor market that stays quite healthy. And, lots of uncertainty around that, but I still see that possibility as being very much the path that I believe and hope we're on.
On inflation, you said previously that you think it's going to take longer than thought for inflation to come back sustainably to 2%. Given the information that you gleaned today on the ground, in conjunction with some of the more official data that we've gotten at the start of the second quarter, namely that cooler than expected reading on May CPI, expectations for a softer PCE, are you still maintaining that view, or do you think we will see inflation come down faster as we go through the summer months?
I think that it's going to take some time. I think what we've seen in the data, and again, consistent with what I heard on the ground today, is things are very volatile. You get some welcome news and then they're challenging news. And so I think it's really important not to overreact to what has been encouraging. I think the data that we have seen recently in terms of CPI, in terms of the producer prices, is consistent with an economy that in an orderly way is becoming better aligned. But we also, first quarter, saw news that was more disappointing, and the inflation numbers in particular, but other data as well, those monthly numbers are really volatile. The volatility is still quite elevated. And so I do think we have to be patient because one of the things I heard firsthand is how important it is for us to return to a sustainably low and stable inflation. It matters for people, and we want to make sure that we really stay the course.
So from this point forward, you think it's going to be more volatile? Perhaps the May CPI number that we saw was a bit of an anomaly. Do you think we will see progressive cooling from here? And we saw 3 quarters of inflation data that was higher than expected, zapping your confidence. Would 3 months of lower inflation data restore that confidence?
So I think it has been volatile. I don't know that I expect it to become more volatile, but I think what we've seen is continued volatility relative to before the pandemic. And I think we're going to have to let the data really tell us when it's clear that we're sustainably on a path. And that means looking at a wide range of data. I like to talk about a constellation. There are lots of different pieces of information that I think it's important to come together. And, you know, I do think...
Will 3 months of lower inflation data restore your confidence?
That would help, and I would say, you know, at looking after the very positive disinflation with strong activity in the second half of 2023, I still needed more confidence at that stage. And so I do think that it'll be important to see more information that is consistent. We don't have to get all the way back down, but I do think that, for example, some components are likely to take more time. I think shelter inflation is likely to take more time. I think services, other services, we've seen some good news, but I think there's some parts to that we're just going to have to be patient.
So given what you just said, is September too premature to think about cutting rates? Are we looking at something later in the year, more like November, December?
I think we're going to have to let the data tell us. So it seems to me that there are very plausible scenarios where we, you know, later in the year it would be appropriate if we see strong continued good news on inflation and an economy that is aligning.
That sounds like November, December.
Well, you know, I think that we need to see. So again, I'm not going. I think we have learned that there's no crystal ball, that there's no preset path. We have to let the data tell us, and it's not one or two indicators. It's looking more holistically at the information.
Are you looking at 1 or 2 rate cuts at this point, given where things are?
I could imagine scenarios that would be consistent with both. I mean, I think that as I look forward, my view of how much easing might be appropriate this year has been reduced as I looked at the data, and that's consistent with the summary of economic projections that all of the participants put forward last week. And so I think one way to think about that is that there are different scenarios that might be plausible in terms of what might be appropriate.
So your baseline is 1, it sounds like.
I think we'll have to let the data tell us.
Before I let you go, what's the risk that in the quest to gain confidence that inflation is dropping sustainably back to 2%, that you hold rates at current levels so long that you sow the seeds of a recession?
So the risks are absolutely two-sided, and both sides of our mandate are top of mind for me. So I do think that there is a risk that if we held too long, we would see more slowdown than we need. And that's something that I watch carefully. You know, I think that labor markets are still strong. I think they are not overheated the way that I would have described them earlier, but continuing to watch what's happened across a range of indicators in that space is also important in terms of the timing that will be appropriate to change the stance. So it's balancing the risks of prematurely easing, and it would be, you know, if we prematurely ease, we're just going to make it that much harder to do the work we need to do. But to your point, we certainly don't want to wait too long, and so it's a risk calculation.
All right, Susan, we're going to have to leave the live portion of this interview here for now, but thank you so much for your insight.
A pleasure.
We're going to continue this conversation on tape, and we will have more for you on that this Friday. Josh, I'll send it back to you in New York.
Thank you, Jennifer. The S&P 500 and Nasdaq notch new record highs, extending the rally, while Nvidia surpasses Microsoft to become the most valuable public company. Yahoo Finance's Jared Blickery joins us here with more on the trading day takeaways. Jared.
You know, today is the Global Fund Manager Survey as published by the Bank of America. And this is something I look forward to every month, get a lot of great charts out of it. You get a feel for what asset managers, they have 2/3 of $1 trillion under management. So these are some big names in here. And as a group, they can kind of, you get a sense of where things are going. And when the herd gets to one extreme, well, you can do the opposite. That's what Bank of America recognizes here. So my takeaway number one is Wall Street is quadrupling down on the Mag 7 trade. And I'm not saying doubling or tripling down, they're quadrupling down. You can see 69% are saying long Magnificent Seven. 69% is a big number. In fact, when you get into the 70s, this is sounding like the 2020s when long tech was also the most crowded trade. So I point out that consideration because what happened after that? We had another boom year in 2021. Then we had that huge bear market in 2022 where we saw gains just evaporated. So all of this crowding sets up the potential, not necessarily, but the potential for some downside there in those big names.
And sort of, we were talking, Jared, kind of featured that hot theme we're talking about now, which is like, yes, we have a rally, but it's been narrow, really led by big tech and kind of over, outperforming everybody else.
Yeah, and to be fair, most rallies historically are crowded trades, but this one is just a little bit more crowded than usual, and so we're paying attention to that. Now, my second point here is commercial real estate concerns. They are rising, and this is a long phenomenon. You were just telling me about a conversation you were having with a guest. This is going to take a long time to play out because that's the way these leases are structured. They're usually over 10 years. But here's a chart that shows when we're thinking about systemic credit events, and that's something that affects the entire investment sphere in the world. Commercial real estate, 34%. That's a pretty big number. And remember shadow banking from the global financial crisis? Well, that's still at 22%. You have all these subprime auto loans that are being foisted on, through the ABS system. U.S. government debt. That's another one. The rates have been variable and also volatile. That can spill over into other things. China real estate, that's kind of an echo of U.S. commercial real estate, but not. It's actually a completely different problem. And the yen just surfacing here. So that big problem they have over in the Bank of Japan where they are looking to increase rates.
It was interesting, though, Joe, because we were talking about David Steinbach from Heinz on the show.
Yes.
And we had a discussion about CRE. And I would say he said it generally more positive. I guess his only point was, when he does his work, his firm does the work, it's kind of dangerous to do paint a broad brush. In other words, he says there's such differences downtown to downtown, even building to building. Exactly, right.
We got to move on here, I think. Broadcom, this is my third takeaway. We talk about chip stocks, Nvidia, the biggest stock in the solar system, but Broadcom is actually outperforming Nvidia over this 7-day rally. And it's been a massive 7-day rally, but let me just sort by performance. Here we go. AVGO, that's Broadcom, up 28%. Then ARM, right there neck and neck. SMCI, we got Skyworks, we got Micron. You got to go down the list. NVIDIA's on the second row, but I will say this, I'm going to close with this. I'm going to show our Nasdaq 100 heat map where NVIDIA is in that #1 spot there to close the day.
Stacey Rasgon from Bernstein calls Broadcom one of the best AI stories in the industry.
That's interesting.
Still bowled up.
I could have a conversation about that, but I know we don't have time.
Jared, thank you, my friend. Appreciate it. More asking for a trend on the other side. BofA Securities Global Fund Manager survey sentiment is the most bullish since November 2021. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Yeah, this is our chart of the day here today. You just heard Jared talking about this fund manager survey, which is closely watched by us here. And basically, you've got the sentiment right about here. You can see that it does. I mean, this is a long-term chart going back to 2001. And you can see that sentiment does tend to swing between extremes. It is the highest that it has been in quite some time, but it is not yet at an extreme, according to Bank of America. They measure this by looking at the sentiment from their fund manager survey. They also look at things like cash levels, equity allocation, and economic growth expectations. And they're saying here global risk sentiment is not yet extreme. So that's something that is positive because it's in extremes when you see sort of snapbacks potentially in the market here. So if you look at this chart, just to give a little context, down here, when the sentiment was quite low, is when we saw the collapse of Silicon Valley Bank. So just a little bit of context there for some of the swings that we see in this. In addition to Bank of America bringing us this chart, some of the, again, the color behind us here, 73% of their respondents to their survey say they see no recession right now, especially when you look over the next 12 months, and that soft landing is sort of the consensus here, and that hard landing expectations are at new lows. Also, just 8% say that there will be no rate cuts for the next 12 months. So most people are looking for a rate cut. In fact, 39% in the survey said they expect the first cut to come in September. So that's sort of the backdrop for this bullishness that we are seeing here. Low expectations for a recession and expectations for the Fed to begin cutting rates. And also, as you talked to Jared about, still some optimism here around large cap tech and earnings performing in that particular arena. Back to you, Josh.
Julie Hyman, thank you. And that is a wrap on today's Asking for a Trend. Be sure to come back Thursday at 4:30 p.m. Eastern for all the latest market moving stories affecting your wallet. Have a great night.